Hello everyone and welcome to today's video on how to grow your stock portfolio like an expert. Now, I know that investing in the stock market can be a daunting task for many, but trust us, it's one of the most powerful tools for building wealth over time. Whether you're just starting out or looking to enhance your existing portfolio, this video is packed with valuable insights that can help you on your journey to financial success. Understanding the world of stocks and investments is crucial in today's fast-paced financial landscape. The right knowledge and strategies can make a significant difference in your long-term financial security. So if you're eager to take control of your financial future and make informed investment decisions, you're in the right place. Let me share a personal story with you. A few years back, I was in the same position, unsure of where to start with investing. But through careful research, trial and error, and staying committed to my goals, I managed to turn a modest investment into a thriving stock portfolio. It's not about being a financial wizard, but rather about understanding the fundamentals and having a disciplined approach. And that's exactly what I'm here to help you achieve. So let's dive into the basics of growing your stock portfolio like an expert. Step 1. Understanding the basics. Before we get into the nitty-gritty of stock investing, let's establish a strong foundation by understanding some key concepts. First and foremost, what is a stock portfolio? Essentially, a stock portfolio is a collection of different stocks or securities owned by an individual or an entity. It's like a basket of investments that allows you to spread your risk and potentially increase your returns over time. Think of it as building a diversified team of players in a sports team. Each player brings a unique skill set, and together they create a winning combination. One of the most crucial principles in stock investing is diversification. This means spreading your investments across various assets and industries to reduce the impact of any single investment's poor performance. Diversification is like having a safety net for your portfolio, helping to mitigate risk and protect your hard-earned money. We'll delve deeper into how to achieve effective diversification later in this video. Now, let's talk about different types of stocks. There are three main categories to be aware of: blue chip growth and value stocks. Blue chip stocks are typically established, reputable companies with a long history of stability and reliability. They're like the seasoned veterans of the stock market. Growth stocks, on the other hand, represent companies with a high potential for rapid expansion and revenue growth. These are often newer, innovative companies that can offer significant returns, but also with higher volatility. Lastly, value stocks are those that are considered undervalued or trading below their intrinsic worth. These can be hidden gems with the potential for substantial gains. Step 2. Setting clear goals. Setting clear and well-defined goals is the cornerstone of successful investing. It's not enough to simply throw money into the stock market and hope for the best. That's why we emphasize the SMART goal framework: specific, measurable, achievable, relevant, and time-bound. Specific goals give you a clear target to aim for, while measurable goals allow you to track your progress. Achievable goals are realistic within your current financial situation, and relevant goals align with your overall life objectives. Lastly, time-bound goals set a deadline, creating a sense of urgency and accountability. Let's explore some common investment goals that many individuals pursue. First and foremost, the goal of retirement planning. Building a substantial portfolio can provide you with financial security and freedom in your golden years. Another common goal is saving for a major life event like buying a house. This requires careful planning and disciplined investment strategies. And then there's education. Whether for yourself, your children, or other family members, investing for education ensures that you or your loved ones have access to quality learning opportunities without financial strain. To align your investments with your goals, consider the time horizon, risk tolerance, and expected returns associated with each objective. For instance, a retirement goal might allow for more aggressive investments since there's a longer time frame, whereas a short-term goal like buying a house may require more conservative strategies to protect your capital. Remember, your goals should drive your investment decisions, not the other way around. With a clear roadmap in place, you'd be better equipped to make informed choices that lead to financial success. Step 3. Conducting research and due diligence. Before you put your hard-earned money into any investment, it's crucial to do your homework. Thorough research and due diligence are your best weapons against making hasty or ill-informed decisions. Start by understanding the company or asset you're considering. Dive into its financials, market positioning, and growth prospects. There are several reliable sources of information you can tap into for comprehensive stock analysis. Stay updated with financial news from reputable sources to get a sense of the broader economic landscape and its potential impact on your investments. Company reports, including annual reports and quarterly filings, provide an in-depth insight into a company's financial health, operational performance, and future outlook. Additionally, pay attention to analyst recommendations and industry reports. These can offer expert opinions and market trends that can guide your decision-making process. When evaluating companies, consider its financial health. Look at its key metrics like growth revenue, profit margins, and debt levels. A company with consistent and healthy financials is more likely to weather economic storms. Next, assess its competitive advantage. What sets the company apart from its peers? Does it have a unique product, a strong brand, or superior technology? Finally, examine the growth potential. Is the company in an industry poised for expansion? Are there upcoming product launches or strategic initiatives that could drive growth? Step 4. Building a diversified portfolio. Diversification is a critical principle in building a resilient and successful investment portfolio. It involves spreading your investments across different industries, sectors, and asset classes to reduce the impact on any single investment's poor performance. Think of it not as putting all your eggs in one basket. The benefits of diversification are substantial. It helps mitigate risk, as the fortune of different sectors often move independently of each other. This means that even in one area of your portfolio experiences a downturn, the other areas may still well perform, providing a cushion for your overall returns. There are various strategies to achieve diversification. One common approach is through the use of exchange-traded funds and mutual funds. These investment vehicles pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, and other assets. They offer exposure to a broad range of companies and industries, making them a convenient way to achieve instant diversification. Alternatively, you can opt out of individual stock selection, but this requires careful research and a keen understanding of various industries and sectors. Step 5. Risk management and asset allocation. Understanding your own risk tolerance is a fundamental step in creating an investment strategy that aligns with your financial goals. Risk tolerance refers to your ability and willingness to withstand fluctuations in the value of your investments. It's a deeply personal consideration and depends on factors such as your financial situation, investment timeline, and comfort level with market volatility. For example, if you have longer investment horizons and can tolerate some ups and downs, you may have a higher risk tolerance. Conversely, if you have a shorter time frame or a lower tolerance for market fluctuations, you may prefer a more conservative approach. Asset allocation is another crucial aspect of risk management. It involves dividing your investments among different asset classes like stocks, bonds, and cash. The allocation you choose has a direct impact on the overall risk and potential return of your portfolio. Generally, stocks are considered higher risk, but they also have the potential of higher returns over the long term. Bonds, on the other hand, are typically lower risk, but offer more modest returns. Cash or cash equivalents provide stability and liquidity, but with lower potential for growth. Step 6. Long-term versus short-term investing. When it comes to investing, one of the key decisions you'll have to make is whether to adopt a long-term or short-term investment strategy. These two approaches have distinct characteristics and cater to different financial goals and risk tolerances. Long-term investing is a strategy focused on holding investments for an extended period, typically 5 years or more. The primary goal of long-term investing is to capitalize on the growth potential of your investments over time. This approach is well suited for individuals with a patient outlook, as it allows you to ride out market fluctuations and benefit from the historical upward trajectory of the stock market. Long-term investors often benefit from the power of compound interest, whether the returns on their investments generate additional income over time. On the other hand, short-term investing involves holding investments for a shorter duration, often less than a year. This strategy is more focused on capitalizing on short-term price movements or taking advantage of specific market conditions. Short-term investors may engage in strategies like day trading or swing trading to profit from market volatility. While short-term investing can lead to quicker gains, it also carries higher risk due to potential for increased market volatility over short periods. Both strategies have their benefits and potential drawbacks. Long-term investing offers stability and has historically delivered consistent returns over extended periods. It allows you to weather market downturns and benefit from the compounding effect. However, it requires patience and the ability to withstand market fluctuations without becoming overly reactive. Step 7. Monitoring and adjusting your portfolio. Once you've built your investment portfolio, it's crucial to understand that your work doesn't end there. Regular monitoring of your investments is essential to ensure they continue to align with your goals and risk tolerance. Evaluating the performance of individual stocks and the overall portfolio is a critical part of this process. Start by examining each investment's performance relative to your expectations. Consider factors such as earning reports, market trends, and significant news or events related to the companies you invested in. Additionally, assess how much investment contributes to the diversification and overall risk profile of your portfolio. Keep an eye on broader economic indicators and market trends as well. These can provide valuable context for understanding the performance of your investments within the larger financial landscape.